Welcome back to Investing Talk Podcast. Sometimes the market just, it throws us curveballs.
Yeah.
And today we're going to try to unpack one of those.
Oh, yeah, for sure.
We're looking at UiPath and trying to figure out why its stock plummeted, even though they beat their earnings expectations for Q4 2025.
Yeah.
On the surface, it seems like UiPath is riding the wave of AI and automation, but the market seems to be telling us a different story. So we've got a stack of sources, the earnings reports, some market analyses, even some technical charts to try and piece this puzzle together.
It's that disconnect between, the strong performance on paper and then the market's reaction. That's particularly interesting.
Absolutely.
Looking at the numbers, UiPath did beat predicted earnings per share, reaching $0.26 compared to the expected $0.20.
And they didn't just meet expectations, they surpassed them.
Yeah.
Yet the stock took a hit. What gives?
Well, their revenue was slightly less than projected.
Yeah.
$424 million against an anticipated $425.1 million. But their annual recurring revenue, ARR, saw a significant increase.
Hold on. For our listeners who might not be familiar with that term,
Right.
could you explain what ARR means and why it's important?
Of course. ARR, or annual recurring revenue, essentially tells us how much predictable revenue UiPath has secured for the coming year.
Got it.
It's a vital metric for gauging the health and predictability of a company's growth, especially for a subscription-based business like UiPath.
Right.
Now, their ARR jumped by a healthy 14% year over year,
Okay.
reaching $1.666 billion.
So they're bringing in more recurring revenue, exceeding earnings expectations, yet the stock drops. This is where it gets really interesting.
Yeah.
What do you think is behind this apparent paradox?
Well, the market appears to be laser-focused on UiPath's guidance for the upcoming year, which was more cautious than some analysts anticipated.
Right, their guidance. For Q1 of fiscal year 2026, they're projecting a non-GAAP operating income of $45 million, and for the full year, they're anticipating $270 million.
Right.
This cautious outlook seems to be spooking investors.
It appears so, yeah. Management attributed this conservative projection to the uncertainties in the global macroeconomic environment, specifically highlighting the U.S. public sector.
So how did the market react to this cautious guidance?
UiPath's stock price took a significant dip, plunging roughly 17% in after-hours trading.
Wow.
That brought the price down to below $10 per share from its pre-earnings level of around $11.87.
That's a considerable drop, especially considering the positive earnings.
Yeah.
This seems to highlight a growing trend in the market where future guidance often overshadows current performance, particularly for growth stocks like UiPath.
It does, yeah.
Is that what you're seeing?
It's a pattern that's becoming increasingly prevalent.
Okay.
For growth-oriented companies where future expectations heavily influence their valuation, even a slight hint of caution can trigger a negative market reaction.
Now, on top of the earnings release, there was another significant development on March 12th.
Right.
UiPath announced its acquisition of Peak.
Peak, a company specializing in AI agents.
Right.
This strategic move suggests UiPath is doubling down on its commitment to AI-powered automation.
And this isn't just theoretical.
No.
They've already got a success story to showcase the potential of this acquisition involving Heidelberg Materials.
That's correct. The Heidelberg Materials case highlights the power of Peak's technology within UiPath's agentic automation platform, showcasing their push into vertical AI solutions.
So we've got a company exceeding earnings expectations, demonstrating strong ARR growth, and making strategic acquisitions in the booming AI space.
Right.
Yet the market responds with a sell-off.
Yeah.
It does seem like investors are prioritizing future guidance over present performance.
It seems so, and this emphasis on guidance is further fueled by the current macroeconomic climate.
Right.
With uncertainties looming, large investors are looking for reassurance and confidence in a company's ability to navigate the choppy waters ahead.
It makes sense that investors would be more cautious in an uncertain economic environment.
Right.
It seems like UiPath is facing a sort of double whammy here. A cautious outlook and a skittish market.
That's a good way to put it.
Yeah.
It creates a challenging situation where even positive performance might not be enough to instill confidence.
But even with all this happening, there was another twist on March 12th, the return of UiPath founder Daniel Dines as CEO.
Oh yes, Dines' return.
Yeah.
This development certainly adds another layer of complexity to the UiPath story.
For sure.
His previous success in steering the company's early growth phase is well documented.
Absolutely.
His leadership style, known for its agility and focus, was instrumental in navigating those early challenges.
Yeah.
The question now is, can he replicate that success in this new, more complex landscape? It's a big question. Investors are undoubtedly hoping Dines can recapture that magic and steer UiPath back on course. But let's be realistic, the competitive landscape has intensified significantly since Dines' previous tenure.
Absolutely. You have established players like Microsoft flexing their muscles in the automation and AI space, and then you have the constant influx of new, agile AI startups, each vying for a piece of the pie.
Right.
It's a crowded field, and UiPath is going to have to fight hard to maintain its position, even with Dines at the helm. But before we dive into those competitive dynamics, let's circle back to the technical side of things. You know how the market sentiment is reflected in the actual price movements of UiPath stock.
Before the earnings release, UiPath stock was relatively stable, trading within a range of $10 to $14 over the past 9 months. This period of consolidation suggested a lack of clear direction, but the earnings release and subsequent guidance triggered a decisive move.
And that move was a sharp downturn. The stock plummeted below $10, nearing a critical support zone between $9 and $10, a level that held firm during previous sell-offs in 2024.
This breach of the support zone, coupled with the significant drop in price, indicates heightened volatility. In fact, the actual price swing exceeded the 14.3% fluctuation predicted by options markets. This suggests a higher level of uncertainty and risk surrounding the stock.
And we can see this heightened risk reflected in some key technical indicators. For instance, UiPath stock is now trading below both its 50-day and 200-day moving averages.
These moving averages, which essentially track the average price of the stock over a given period, are often used by traders and investors to gauge momentum and potential trend reversals.
Right, and in UiPath's case, the fact that the stock has fallen below both of these key moving averages reinforces the negative sentiment currently surrounding the company. Remember that golden cross back in January when the 50-day moving average crossed above the 200-day moving average? Well, that bullish signal seems to have been a bit misleading.
Yeah, the current picture with the stock trading below these moving averages suggests the bears are in control for now. However, there's one indicator that offers a glimmer of hope for those seeking a potential rebound.
You're talking about the Relative Strength Index, RSI, right?
Precisely. The RSI, which measures the magnitude of recent price changes to evaluate overbought or oversold conditions, currently suggests UiPath stock is oversold.
For our listeners who might not be technical analysis gurus, could you unpack what an oversold condition actually means?
Think of it like a rubber band being stretched too far. Eventually, it needs to snap back. In the context of stock prices, an oversold condition suggests that the selling pressure has been excessive and a price bounce might be in the cards.
So does this oversold RSI signal a guaranteed rebound for UiPath?
Not necessarily. While it suggests the stock may be due for a bounce, we need to see confirmation in the form of price stabilization and an increase in buying volume. If UiPath stock can hold above that crucial $9 to $10 support zone and we start seeing more buyers step in, then we might have a genuine rebound opportunity on our hands.
Okay, so there's potential for a turnaround, but it's not a certainty.
Yeah.
So for investors who are considering buying UiPath at these lower prices, what's the risk-reward scenario look like? What are the potential pitfalls and what are the potential upsides?
On the risk side, the ongoing macroeconomic uncertainties and the potential for further downward pressure if UiPath breaks below that $9 support level are key concerns. The high volume we witnessed during the sell-off also raises a red flag as it suggests a strong conviction among sellers.
But there's a potential silver lining, right? I mean, Wall Street analysts haven't completely abandoned UiPath.
That's right. UiPath is currently trading significantly below Wall Street's median 12-month price target of $16. This implies substantial upside potential if the company can successfully navigate these headwinds, execute on its vision, and regain the market's confidence.
So we've got this interesting dynamic. On the one hand, we have the tangible results, strong earnings, growing ARR, strategic acquisitions in the AI space, all pointing to a company with solid fundamentals. But on the other hand, we have the looming macroeconomic uncertainties, a skittish market, and a competitive landscape that's becoming increasingly fierce. It's this tension between present performance and future uncertainty that seems to be driving the market's reaction.
That's a really astute observation. It's almost as if the market is trying to reconcile UiPath's strong current performance with the potential risks and challenges that lie ahead. It's a classic case of weighing the known versus the unknown.
And for investors, this creates a real dilemma. Do you jump in at these lower prices, betting that UiPath can overcome these hurdles and achieve its long-term potential? Or do you wait on the sidelines, watching how the situation unfolds before committing your capital? It's a tough call, and there's no easy answer.
It boils down to your individual risk tolerance, investment horizon, and conviction in UiPath's ability to execute. If you're a long-term investor with a belief in the transformative power of automation and artificial intelligence, and you're comfortable with the current level of risk, then this pullback might present a compelling entry point. But if you're more risk-averse or you're looking for a quicker return, then waiting for more clarity might be the prudent approach.
One thing's for sure, this is a pivotal moment for UiPath. The decisions they make over the next few months will have a profound impact on their trajectory. Will they be able to leverage Dine's return, navigate these challenges, and emerge as a leader in the AI-powered automation space? Or will they succumb to the pressures and fade into the background? Only time will tell.
It's a story that's still unfolding, and it's one that we as investors and observers will be watching with keen interest.
It's fascinating how, even in a world dominated by algorithms and data, the human element remains so crucial.
Yeah, it really is.
Whether it's the vision of a founder like Daniel Dines or the collective sentiment of the market, these human factors can significantly influence a company's trajectory.
Absolutely.
It's a potent reminder that investing is about more than just numbers on a spreadsheet.
Right.
It's about understanding the stories behind those numbers, the forces shaping the market, and the potential of human ingenuity to drive innovation and growth.
I totally agree with that.
And in the case of UiPath, that story is far from over life. There are so many variables at play.
Yeah.
The macroeconomic environment, the competitive landscape, the execution of their AI strategy, the impact of Dine's return.
Right.
It's a dynamic situation with a lot of potential outcomes.
It really is.
The next few quarters will be crucial for UiPath. They need to demonstrate that they can navigate these challenges effectively and continue delivering value to their customers.
Absolutely.
For investors, this creates an intriguing opportunity to observe and learn. How will UiPath adapt to this evolving landscape? Will they be able to capitalize on the opportunities presented by the rise of AI?
Yeah.
Will their strategic moves, like the acquisition of Peak, pay off in the long run?
Right.
These are all questions worth pondering. And as we continue to follow UiPath's journey, we'll undoubtedly gain valuable insights into the broader trends shaping the automation and AI space.
I think so.
And that's what we aim to do here at Investing Talk Podcast. Provide you with the information and insights you need to make informed decisions.
Absolutely.
Remember, investing is a journey, not a destination. It's about continuous learning, adapting to new information, and staying ahead of the curve.
Yeah, and part of that journey is engaging in thoughtful discussions and sharing perspectives, so we encourage you to leave a comment below and tell us what you think. What are your predictions for UiPath? Do you think they have what it takes to become a dominant player in the AI-powered automation space?
We appreciate you joining us for this episode of Investing Talk Podcast. We hope you found this look at UiPath informative and thought-provoking.
I hope so.
Don't forget to like this episode and subscribe to our channel for more insightful analyses of the companies and trends shaping the market.
And be sure to share this episode with your friends and colleagues who might be interested in the intersection of technology, business, and investing.
Until next time, happy investing.